Welcome to Simply by DealHQ. On this podcast, we engage thought leaders on topical issues around law and business in the most simplistic manner.
Hello everyone and welcome to episode 9 of Simply by DealHQ. My name is Choma, an associate with DealHQ, and today we'll be diving into the Investments and Securities Act 2025, which was signed into law in March 2025 by President Bola Tinubu. And we will be exploring how it is poised to stimulate economic growth within Nigeria's commodities trading ecosystem and by extension across Africa. So one of the key recommendations of the Nigeria Capital Markets Master Plan 2015 to 2025, as well as the revised Capital Market Master Plan 2021 to 2025, is the development of a thriving commodities trading ecosystem to deepen the capital markets and expand the range of available products while also enhancing agricultural and solid mineral production and drive broader economic development. The ISA introduces a comprehensive regulatory framework for commodity exchanges, bringing long overdue clarity, structure, and legitimacy to a sector that has historically operated in a largely informal manner. For years, commodities exchanges like AFEX Commodities Exchange Limited, the Lagos Commodities and Future Exchange, and others have been pushing innovation despite limited regulatory infrastructure. With the passage of ISA 2025, all that industry experience in product development, market behavior, and stakeholder engagement has now been distilled into a clear and supportive legal framework. At the continental level, according to the UNECA, several African countries, including Ethiopia with the Ethiopia Commodities Exchange, Rwanda with the East Africa Exchange, and Kenya with the Africa Mercantile Exchange, have established commodity exchanges. However, many continue to face significant challenges, including food price volatility, lack of regulatory framework, inadequate infrastructure, limited access to finance, and low stakeholder awareness. The World Bank, in its publication Commodities Markets, Evolution, Challenges and Policies, notes that countries heavily reliant on a narrow range of resource-based exports are especially vulnerable to commodity market risk. While economic diversification can help reduce exposure to trade shocks, the World Bank cautions that direct government intervention often proves ineffective. A better approach, it suggests, is to foster a business environment that promotes innovation and investment across all sectors of the economy. As a result, Nigeria must ensure that the implementation of its commodities exchange policy framework drives development of an efficient and well-structured commodities ecosystem that attracts investments, promotes innovation and sustainable development, addresses inherent challenges facing commodity exchanges, and fuels broader economic growth. To lead the conversation with our esteemed guest is one of our partners, Ms. Omobola Adekola.
Okay, thank you very much, Choma, for that. Today, we are joined by our esteemed guests to explore key issues shaping the commodities ecosystem in Nigeria. We'll be discussing the policy framework regulating commodities exchanges in Nigeria and by extension across Africa, and the broader commodities investment landscape on the continent, the risks and the opportunities associated with regulated commodities exchanges and the outlook for commodities exchange investments in Nigeria. Our esteemed guests today are Akinyinka Akintunde and Chris Sturgess. So Akinyinka is the CEO of AFEX, the first private commodities exchange in Nigeria and one of the largest and most successful exchanges on the continent. Under his leadership, AFEX was rated by the Financial Times as the fastest growing company in Africa. AFEX now trades commodities in various countries across Africa, including Kenya, as well as in Europe and USA, among others. And our second guest, Chris Sturgess, is a seasoned expert in commodities markets with over 2 decades of hands-on experience in the South Africa commodity derivatives market. His professional journey is deeply rooted in developing and promoting efficient commodity trading systems, both locally and across the African continent. He started his formal career with South Africa Futures Exchange, SafeX, back in 1997. And he joined a small team that was responsible for developing and marketing the agricultural markets division of SafeX. In 2001, the Johannesburg Stock Exchange, JSE, purchased SafeX, and the derivatives market was included as a separate division within the JSE. Chris had a remarkable 20-year tenure at the JSE, where he was deeply involved in commodity derivatives market. He currently serves as the president of the Association of Future Markets, an international platform dedicated to promoting and supporting the development of futures and derivatives market. It is therefore a great honor to have them both join our podcast, share insights from the perspective of a savvy and consummate stakeholder and participants in the commodities ecosystem. Thank you so much, Akinyinka and Chris, for agreeing to join us.
It's a pleasure, Omobola.
Thank you. Really a great honor.
Thank you. So we'll move right into the questions. So my first question goes to Akinyinka. The ISA 2025 introduces more robust provisions for the regulation of commodities exchanges in Nigeria, formally recognizing them as licensed market institutions with regulatory oversight responsibilities, albeit under the purview of the Securities and Exchange Commission. So from your perspective, how do you anticipate the private sector will respond to this shift? Specifically, do you see it paving the way for the emergence of new commodities-focused investment vehicles? And does this enhance regulatory clarity, significantly de-risk investments, and make Nigeria's commodities market more attractive to both local and international investors? Over to you, Akinyinka.
Thank you, Omobola, and thank you for the opportunity to join you on this podcast. And I must say, the ISA that was signed by the President of Nigeria, President Bola Ahmed Tinubu, is something that is way long overdue. And if you look at the history of Nigeria, commodities exchanges has been one of those key capital markets institutions that has been that a lot of effort has been put in place to ensure it's viable, it's functional and operational. But over the years, due to absence of clear regulatory framework and legal backings for these entities, it's always been a struggle, coupled with the fact that the markets sought to be regulated is a very, very informal one. So I believe the first step taken by the revision of the ISA is a huge one that puts more clarity in terms of regulatory purview and oversight of this ecosystem directly under the SEC. That's a very, very good step in the right direction, having that clarity there. And the way we see this as a private player in the market is that over the years, we've seen a lot of investment that has been directed into this ecosystem. A lot of people wanted to diversify their asset classes from the traditional equities and fixed income holdings to gain exposure into equities. And as you are aware, when you invest in equities, you get to naturally diversify a lot of risk we face on the macro level, like currency devaluation and the likes. So being able to gain a seamless access into that class is something that a lot of private sector players sought. With this bill now an act in play, I believe we'll see increased participation by the private sector players. I strongly believe in the nearest future, we'll see the inflow of a lot of innovative collective investment schemes that are structured around commodities that will be brought on exchanges. And basically, I think the much more desired financing that is required to promote commodities investment as an alternative asset class will be much more available, not only to institutional players but to the retail players. So I believe we're taking this step in the first step in the right direction, and I think the key thing now to focus on is on executing the required action in line with ensuring that the act is more it could be operationalized on, and we see results on the back of it.
Okay, thank you for that, Akinyinka. So I'm going to just I'll take a cue from what you had said initially about the absence of clear regulatory framework before the ISA. So my next question will also focus on regulatory uncertainty. So regulatory uncertainty had long been that's my next question is also for you, Akinyinka.
Yeah.
Regulatory uncertainty has long been a major challenge in Nigeria's commodities sector, often undermining investor confidence. You shared that earlier. So do you believe that the introduction of systemic risk management frameworks for monitoring and mitigating risk in ISA 2025 can address these long-standing concerns, close critical gaps, and ultimately bolster greater investor confidence and broader market participation?
I strongly believe so. So if you look at if you take a very broad perspective of commodities exchanges, when you look at it in the developed world and compare it with Nigeria and to a large extent a lot of countries across Africa, when you talk about commodities exchanges more around derivatives markets, right? And for you to have a derivatives market, the fundamental is for you to have a very, very functional physical market that enables the transfer at the basic form, transfer of commodities from one point to the other, transfer of ownership in a seamless manner. And that works when you have infrastructure in place and you have a sound system governing the play of commodities as it is. When you come to Nigeria in particular, over the years, as mentioned earlier, the market had always been very, very informal. And I always tell people this, almost all of our great grandfathers were probably commodities traders decades ago. So it's not anything new. But because the market is very informal, getting the right regulatory structure on it has been one of those limiting factors. And when you don't have a regulatory structure on it, it's easier for you to see the most basic form of risk crystallize. For example, default risk. A farmer or a producer supplies to a buyer. If there's no legal backing or legal structure on the back of that, it's easier for you to have a default on that. And we're talking about the physical market. Now, ultimately, the idea is for us to get to a derivatives market where we have the capacity and the structure to seamlessly eliminate any potential risk we feel could come on top of that. But before we could get there, the physical infrastructure and infrastructure in general needs to be put in place, which is where we see the play of a lot of stakeholders that are directly addressed by the ISA 2025. So, for example, having accredited warehouses, warehouse operators, collateral managers, they are all key in ensuring integrity of commodities, both in terms of quality and quantity guarantee, both in terms of being able to register the commodities to be eligible for financing and sales subsequently through a commodities exchange. Until we get that right, we won't be able to move to the next step. So, which is why we believe this ISA clearly addresses all those gaps that were missing prior to now, and putting the right structure in place will take us to where we need it to be, to one that gives participants and players in the market an avenue to be able to transfer risk or eliminate risk that they can bear to other parties with bigger capacities to absorb such. when we see that fully crystallized, then we'll see a lot more stability around the commodities ecosystem, even though we are likely going to see increased financing formally going into this ecosystem. And this activity will also have ripple effects across the broader economy, because we believe having this kind of structure will prompt more investments in critical infrastructure like warehouses, logistics systems by private sector in a bid to ensure a bigger play in the commodities ecosystem.
Thank you, Akinyinka. So I'm going to move on to Chris. So Chris, Akinyinka has spoken about the informal market system within the commodities space, and now the ISA coming to put structure in place, and he has also emphasized on some key steps to be taken. So Chris, looking at the developmental trajectories of commodities markets in countries like Ethiopia, South Africa, do you believe Nigeria is aligning with global best practices through the reforms introduced in the ISA 2025, such as the systemic risk management framework and the formal recognition of commodity exchanges as licensed market institutions with regulatory oversight? What key lessons or regulatory strategies from these markets could Nigeria adopt to build a more robust and competitive commodity trading ecosystem? Chris, that's for you. Thank you.
Thanks, Omobola. Is Nigeria aligning with global best practice? Most definitely. I think it's a huge shout out, huge congratulations to Nigeria, to the regulators, and as Akinyinka had mentioned, something that was long overdue. I think it sets a very, very strong base for Nigeria, and it's an exciting next steps, because once you think, what does the regulatory environment strive to achieve? It's providing a framework or an ecosystem where investors, where market participants, everyone in the ecosystem understands what the basic rules are about. And if there is an issue, we know how to resolve it. So it starts to build so much more credibility in that particular asset class or that particular market, and it will and must be able to encourage new investment from outside players. So again, if a investor has confidence in the framework, let's call it, just because we're talking about an exchange, about the rules of the exchange, the operation of the exchange, and they know that they are ultimately protected by regulation, which is in many ways easy to understand, but also easy to execute, it will really encourage that advancement of additional participation. It also means that they'll be interested in allocating more finance. And as Akinyinka had mentioned, perhaps that leads to improving investment in the warehousing, because part of the new act does require the licensing of warehouse operators. And in the commodity space, the warehouse operator is very much involved in also helping build the integrity of the market, because if they are issuing a warehouse receipt to say there is commodity of this quality and quantity, that needs to be there. Yes, if something goes wrong, there needs to be a very clear resolution process, and that's also what this additional enhancement to the regulations will bring. So overall, very exciting times. I think in comparing to other African countries, yes, many of the other players on the continent have also chosen to regulate the spot commodity markets. And so maybe just a quick recap. The spot commodity market, or the physical market, is the trading of physical commodity changing hands, whereas you also have derivative markets which focus on a slightly different function, and it's not necessarily always involved the physical commodity. Now, with this regulation, it goes to regulate both the spot commodity exchanges as well as the derivative exchanges, and that is one step further than South Africa. South Africa does not regulate its spot commodity markets. Many of them operate in an ecosystem outside of the Financial Markets Act of South Africa. So there is a slight difference. But again, I think the nuance is when you as a country are looking to build an ecosystem, a highly functional exchange business, you need to make sure you are introducing overarching regulation which can support that marketplace and ultimately lead to strengthening the integrity of that marketplace. So yes, there's always nuances, there's always differences, but I think the important point is, and you asked about what could be key lessons from these other markets. I think making sure that ultimately as regulator, when you're introducing any new regulation, that you're there to support the market, interpret it, to be able to support the market, understand your requirements, but also to remain as effective and as efficient as you can be with the license applications that go with this regulation. So if there are new licensing requirements for warehouses, make sure that the process to onboard, to either approve or decline, is not an extensive one, but also a practical one. And so, yeah, it does come with many challenges to make sure that once you roll this out, it is practical and achievable. Over to you, Omobola.
Thank you, Chris, and thank you for highlighting the fact that Nigeria has gone one step further in regulating both, one step further than South Africa in regulating both spot and derivative market. And also the fact that the regulators should be ready to support the interpretation, and they must also be effective in license application, amongst others. So, Chris, I'm still coming back to you again in terms of experiences from other countries for my next question. And drawing from the experiences of other countries that have undertaken similar commodity market reforms, what potential pitfalls should Nigeria be mindful of, particularly issues like ambiguous regulatory frameworks or limited market adoption? What practical steps can be taken to ensure the effective implementation of the ISA 2025 to foster both stakeholders buy-in and sustained market participation?
Yeah, so again, I think the way I look at things is as an exchange operator, we don't have the right to exist. As exchange platforms, we are there to provide a service and to make sure we're able to build natural market participant from the services that we provide. But one of our key partners in that strategy is the regulator. So in this case, the SEC, who has now this new regulatory framework in place, and that remains a key partner in the process, in the journey of building out more effective exchanges. You can always license exchanges, but the thing is, will those platforms, those exchanges be able to add value and attract market participants? Now, naturally, if you look at the journey of AFEX and how they've been building more strategic market participation, it is really a phenomenal story to follow. But what I have seen from my experience on the continent is often engaging a regulator is a careful one. It does take time to make sure the regulator understands where we're coming from as an exchange operator. And it does make me think to when the futures market in South Africa initially was founded and was very uncharted territories for South Africa. They'd never had commodity derivatives. And for the regulator, we had overarching regulations which defined securities. And clearly, by trading commodity futures and options, we were trading securities. So it was very much seen as a financial marketplace. And so we were bringing commodity markets place to it. And there I really acknowledge the open-mindedness of the South African regulators who would welcome you to sit around the table. You would explain the dynamic nature of the physical commodity market. And yes, with their financial lenses on, apply and see how they could assist in making sure you could approve and move forward, because ultimately you need their support if you're rolling out new products, new instruments, new market or new asset classes. And so again, I think where sometimes the bottleneck gets caught up is the regulators are very stringent on the process, and maybe missing the idea of trying to keep an open mind and really just have a frank conversation around, okay, what is your objectives? How can you get there as an exchange operator? That said, I totally understand in the landscape that we work today that the regulators also, you need to, as an exchange operator, you need to understand their mission is to make sure that they have an ecosystem that is not open to market abuse. So as an exchange operator, we need to find solutions. If they are worried about market manipulation, the cornering of a particular commodity, which is a staple food, being managed by financial role players, as exchanges, we put forward proposals on how to reduce that risk. And it's just as I say, it's an open conversation to try and find solutions that allows the regulation as it's defined and for the exchanges and its ecosystem to exist. What you really want to try and avoid is where all of a sudden you're imposed additional red tape. And I use the word red tape loosely, but you don't want to be bogged down on that side of things, which prevents the innovation of the market. And in the commodity space, as a continent, we're all striving to increase production. We are desperate for more and more commodity to be produced from our fertile soils. So with that ambition to increase production, which will allow the exchange's ecosystem more commodity to trade, we need to find a way to be able to encourage investment into that production base, but also into then the trading and clearing side of things. So when we talk about the trading and clearing, where we have seen issues in some instances, and I happily share an experience. When we started the derivative market, we, like every exchange, realized we had to convince the market of the value that we provided. And I'll talk a bit later on around what a derivative market's core values are. But we had the participation of a number of pension funds that took out positions on the exchange. And it was also, unfortunately, some of those pension funds held positions that were larger and becoming too big for the size of the open interest, the size of the market that was held. And so that also required frank conversations between the regulator, the pension fund administrator, as well as the exchange, to find a balance around what is the role of the speculator versus the hedger in the marketplace. But again, that experience was openly held by parties, but that's just one example of this is a relationship that the exchange has with the regulator. It needs to really be open, and both parties respect where each of the players are coming from.
Okay, thank you, Chris. I like the fact that you mentioned that the South African regulators were open-minded, and you've also emphasized about that. So our regulators need to be open-minded as much as they are trying to prevent market abuse. It's also important that they work together with the operators and to understand the sort of the ecosystem in terms of innovation and all of the other activities that will be ongoing to attract investment. So Akinyinka, I am coming back to you now. So my next question to you is the ISA recognizes digital and virtual assets. Do you see this as a catalyst for private sector innovation in the commodities space? In your view, how might this recognition unlock new opportunities, particularly in high-impact areas like agri-tech, warehousing, logistics, and digital trading platforms? I can get over to you.
Thanks, Omobola, and thanks, Chris, for the perspective you brought around the whole play of Nigeria in line with the international sector and the international community, as well as the need for increased collaborative effort between the regulatory bodies and the private sector. And Omobola, to answer your question, if you look at the Nigerian ecosystem, we have loads of youths with high capacity to delve into tech, whichever form or shape it might take. Give a young man a laptop, expose him to quality training, and he can develop a very, very technology savvy product that is addressing a gap in Nigeria. And this speaks to a lot of what we've seen in the past around a lot of companies trying to provide agri-tech based services, basically infusing technology into how we deliver agricultural services. A lot of them are more focused around being able to raise capital to drive it. But because of the absence of regulation, we've seen a lot of these things go haywire. Now, marrying that with your question, we believe the ISA directly addresses this and creates a platform for and creates basically the regulatory overview around digital assets. And with that, we believe we'll see a lot more play of digital asset service providers and into the market, and we'll see more talents being put to use in terms of young people developing more product that will solve a lot of issues and gaps we have in the market. However, one of the things I always emphasize on is technology is as good as the fiscal infrastructure that supports it, right? If we don't have enough investment in the fiscal infrastructure, i.e. warehouses, logistics services, functional road network for delivering goods across the country, there's no amount of technology that can solve that for us, right? So my emphasis would always be, how do we drive more investment in infrastructure? There's this number I like quoting every time I talk about infrastructure. When you look at the value estimated ratio, I call it absorptive capacity, meaning what's the total volume of commodities we produce in the country and what's the total storage capacity we have as a country in terms of public storage. And you divide these numbers together, you'll discover that we have less than 5-7% of storage capacity for total production we have, meaning there would always be food losses until we fix this gap. Now, it's possible for us to develop a solution technology-wise that could allow you to know when commodities will get spoiled, shelf life of commodities and everything. But if we don't have the infrastructure to be able to store enough commodities, the issue of post-harvest losses will always be a recurring one. And that shows the value of both technology and infrastructure in driving more investments in the agricultural ecosystem. We need to be able to marry these two together. I still believe there needs to be more investments in infrastructure for us to realize the full capacity of digital assets and play of agri-tech solutions in the Nigerian ecosystem. Yes, the ISA has set a base for it, we're in the right direction, but the next step is, how do we bring the right investment? How do we bring the right infrastructure to drive and solidify the play and entrench the value these asset classes and technology solution brings to fore.
Thank you, Akintunde. You've emphasized on the fact that infrastructure is key to us to realize the benefits of tech innovations, and so we need to put the proper infrastructure in place for that. So my next question is this is for Chris. Chris, with your about 20 years of experience at the GSA Commodities Derivatives Market, you've gained deep insight into how strong regulation can shape a thriving commodities ecosystem. As Nigeria rolls out the ISA 2025, we've asked about South Africa, we're coming about South Africa again. What key lessons can we draw from South Africa's experience? In your view, what are the foundational elements of a regulatory framework that truly stimulates growth in commodities markets? And can you also share specific examples of policies or market infrastructure from South Africa that Nigeria might consider adapting to strengthen its own markets? Thank you. Chris?
Thank you. Omobola, yeah, really, you have the regulatory side of things, and certainly this act helps guide that. But at the end of the day, what is a fundamental game changer for any country is consistent government policy around the movement of that commodity. So why do I say that? Is if you look at when you're trying to build an infrastructure, you want to encourage investment into a marketplace, so investment into roads or into storage. Those are long-term investments. And so those players willing to put down money and invest in that are looking for stability in the long-term policy nature of trading the commodity. And so really from the outset is if you're looking to build certainty in the investment side of things, the market participants don't want to see import or export bans. They want to see a framework which is consistently applied year in, year out. There was a very, very scary moment for many South African farmers back in 1994, 95, 96, where they had moved from a regulated market environment where government set prices, and they were terrified because all of a sudden now supply and demand would set prices. But the government had then, back in 1996, made a very firm commitment to say that we will not be intervening in first of all, the setting of prices, and we are not intervening in the movement of commodity as long as it meets our phytosanitary requirements. So you as a producer, if you want to export, you can export. If you want to import as a miller, you can import. And that's the base rules. And those rules have been consistently applied for over 30 years. That has built an ecosystem where if there's new investment required in storage, market players, free market players, commercial money is willing to invest there and build those storage solutions so that they know if the commodity is in there, they have alternatives. Where can they sell? And so I think really, again, a great step by Nigeria in the regulatory side with this new act, which sets the ground rules. But another very confident and bold move would be saying, now we understand that some commodities may be political. Historically, we could earn votes if we were able to set a price of a commodity very high as the government. But you have to also look back and say, are you really helping the long-term development of that market if you are intervening in the price? And I think this is the challenge that as a government you have is, what is your role? Are you there to try and provide that ecosystem that encourages production to keep growing so that your food security, not only for your country, is safe, but also that you are able to look at exporting and generating foreign reserve for your country? Or is it to look at, yes, we want to set a price that protects the farmer today, but where does the funding for that protection come from for government? And so this is a real challenge. I see it and have had the privilege of working with many of the Zambian market players as they've gone through election after election where certain political players would set a very high price for maize. Unfortunately, even in a very instance, that particular political party set the price very high and still lost an election. And so what did that leave? It left the country with a heavy financial burden because they'd paid a higher price but didn't necessarily have the financial resources to do that. So, yeah, a key scenario again is, and I understand and respect that each country does have a different approach, but it does one big step in trying to encourage the investment by private sector is to look at how do you bring in policy around the marketing of commodities, allowing for imports and exports, but within a controlled way. And when I say in a controlled way, is rather focus on defining the phytosanitary requirements. So you don't want to import something that is going to be a health risk. So rather have the phytosanitary requirements in place. And then if you do feel that as a country you want to restrict the movement of grain. Rather have a very clear and easy, understandable policy that doesn't require on a minister to sign on it, but requires on market conditions to trigger it. And what I mean there is, if you are going to prevent the export of commodities, then as a country you need to also say that if your stock level gets to 5% of your usage for the next few months, that's the only time you will then prevent exports. So that kind of enabling policy environment around the trading of commodities would really see a big game changer, in my opinion, in building confidence in investments, but confidence also around market participants, being both the farmer and the miller, understanding if prices are high, I will be able to benefit from those high prices. But in the same way, if there is overproduction and we can't find markets, I understand and accept that particular year prices will be lower. But at least you're working towards long-term increased production and a more consistent policy. Hopefully that came across clearly. Omobola?
Thank you, Chris, for that. To capture your thoughts, basically policy stability. There must be an enabling policy environment to attract investments in within the ecosystem. So my next question, Akinyinka, this is for you. So in line with the ASA, how can non-agricultural commodities be effectively mainstreamed into the market? Would it be preferable to establish specialized exchanges for these products, or should we focus on strengthening and evolving existing exchanges to accommodate them while ensuring market efficiency, transparency, and investor protection?
Thanks, Omobola. So when you look at the structure I personally work with is, if you can solve for agricultural commodities, then you already have the framework to be able to address any other type of commodities, either agricultural or non-agricultural based commodities. And when you look at the whole ecosystem as a whole, a lot of structures being put in place to address the gaps in the agricultural ecosystem are actually required for you to have for you to trade other commodities. So when you take mining of minerals, for example, you need to be able to set standards in place. You need to be able to have a place where a structure where you set the quality, determine the quality, and then basically the structure for delivering it, and then on the back of that, price discovery for trading, and then being able to bring the whole market players together in place. That is basically what is required and what we have in place for commodities exchanges. So do we need to set up more specialized, or do we need to set up specialized exchanges for other commodities? My position would be non-agricultural based commodities. My position would be, I don't believe we need to. But if you look at it on the other hand, the requirement for you to effectively operate a commodities exchange, especially at the current level of market development, is one that is very huge, right? There's still a lot of activities to be done. So when you look at the percentage of the market that is currently actively traded on the commodities market is less than 5%, right? Significantly lower than that. And this is also a market operating at less than 40% capacity in terms of overall productivity. So there's a huge play to be done in the commodities market, which is where the role of engaging with stakeholders is very, very critical. There's only so much commodities exchanges can do alone and with regulatory bodies without engaging the broader markets. And the bulk of the work for commodities exchanges is more around market development. How do you engage key stakeholders in terms of developing the standards, the structure that is required to transact on the exchange. So it's a whole lot of work. And when you look at it from that angle, then it could make sense for you to set up specialized exchanges. But I still think if you have a functioning commodities exchange with a strong regulatory framework that supports its operation with the required legal backing, then it's easier for the commodities exchange to be able to have a structure for dealing in both agricultural and non-agricultural based commodities.
Thank you, Akinyinka. So you mentioned if there's a functional commodities exchange, it can accommodate both agricultural and non-agricultural commodities. Even if, yes, you can set up another one, but if the commodities exchange is functioning, we can accommodate both with that. Thank you, Akinyinka. So, Chris, I'll ask you another question now. So, what key structural and regulatory steps will Nigeria take to build a resilient secondary market for commodity derivatives? And if successful, what impact could a thriving secondary market have on Nigeria's economy?
Thank you for that question. I think just to tag on, with the previous question around, do you need to have separate commodities on separate commodity exchanges? I think, again, when it comes to operating a licensed commodity exchange, ultimately you're trying to use the existing base of technology and ecosystem and allow other asset classes to benefit from it. So you don't only need to focus on purely agricultural. If there's space in the minerals market, then by all means go in that space. If there is an opportunity in the carbon markets, why not allow the carbon markets to be also traded on the same exchange platform? So I know in other Asian countries there have been more strict compliance, and even to say that only certain commodities trade on this exchange versus another exchange platform. But I think if you're able to provide the motivation to the regulator that your exchange platform is able to facilitate the buying and selling of underlying commodities as broad as they can be, there's no reason why you can't provide that service. Now, to a very exciting next step is the secondary markets. So we've spoken about derivatives, and their core function is around providing price risk management as well as then the price discovery side of things. And I think a natural evolution is, if you have a liquid spot platform operating, why not then also extend and launch derivative contracts? Because you already have access to the spot market players, the physical traders, but now by introducing derivatives, you are able to also extend a hedging opportunity for that market participant. And what do I mean by that? So we throw out derivatives as a loose term. In essence, there are two underlying core instruments, either futures contracts or options contracts. In essence, you are trading a future dated commitment. It might be a contract that expires in 3 months' time, and only in 3 months' time would you then need to either take delivery of the commodity or make delivery of the commodity, or even just unwind your position on a financial basis. But the most important ability is that you can forward price, you can forward sell and forward commit to something that's either 3 months, 6 months, 9 months out. And what does that do? That is a fundamental game changer to any player in the ecosystem. So a farmer for the first time is able to lock in a price and understand that that price is guaranteed before he even starts producing the commodity. A miller is able to buy and price in commodity that they will need 3 months or 4 months from now. But it also encourages financiers to step in and finance commodities stored in the warehouse, because they have a mechanism where they can offlay the price risk. Without a secondary market or without a derivative market platform, it is very difficult for that price risk management portion, that managing of the price volatility. And so that is definitely a very next exciting step, I think, for Nigeria. I know AFEX have been working very closely to roll these out, and I fully support any other African country that can look to diversify and move into the derivative contracts. Is just so important to be able to also unlock, as I said, access to much more cost-effective financing, but you're also encouraging new market players to get involved and help facilitate increased liquidity in those contracts.
Okay, thank you very much, Chris, for that. I'm going to move on to the last question now for both of you. So, Chris, you'll still take it first, and Akinyinka will respond after you. So, this is what's one thing that Nigeria's regulators must get right now to ensure it becomes a benchmark commodities market across Africa in the next decade?
Thank you. I appreciate the opportunity to go first. I think for the regulator, and now particularly for the SEC, is you can be very proud of the new regulations. Congratulations. But I think the important thing is remain approachable. Understand and see how you could work with the licensed exchange, who is your partner in this process, to be able to enhance the product diversification strategy for Nigeria. For one other regulator would be the key policy maker around the movement of commodities. And here is allow for consistent policy around either export or import bans so that they become less, and it really encourages more investment and more consistent policies in that space.
Okay, thank you, Chris. Akinyinka.
Thank you, Omobola. Thank you, Omobola. I couldn't have said it better than Chris. And I believe the handshake with stakeholders is what needs to be gotten absolutely right. And it's more pertinent, especially because we are moving from a highly informal market to one that needs to be formalized, and then bring in more structured capital market players to play more in an informal market. So the SEC needs to find a way to work with all key stakeholders and marry those that are familiar with rule structures and play in the capital market as it is, and the informal market to encourage them to be able to play on exchanges and then build on that success to build the markets we have. I think it's very, very critical we get it right at this stage, because the success in this stakeholder engagement will drive the next phase of development for commodities exchanges. I don't envy the SEC as well. They've been running equities market for decades, fixed income markets for a little while now. The commodities market is a totally different one. Coming into it with the same approach as what we have in the equities markets may not work if we don't come together with key stakeholders to develop what is required, those things that are peculiar to commodities market, for us to establish it and work together to make it something that works, not only for the commission but for the market as a whole.
Thank you so much, Akinyinka and Chris. One key thing that both of you have emphasized in all of your responses has been that the regulators must remain approachable and open-minded, and the fact that the sector has been an informal one, and bringing in structured capital market operators, there has to be a way to be able to, for all stakeholders to collaborate, and the regulators have to, leading this, and they must be approachable because of the different challenges that will come along the way. And for us to sustain this ecosystem, working together and collaboration is key. Thank you so much, Akinyinka and Chris. I'm going to hand over back to Chioma now. Over to you, Chioma.
Thank you, Mr. Akinyinka and Chris, for taking time out of your busy schedule to discuss with us today. I gained a lot, and we are glad to receive from your wealth of knowledge on today's matter of discussion. We would also like to say a very big thank you to our listeners for tuning in. And as always, the conversation continues on all our social media handles. Do remember to send us your comments and thoughts on today's episodes.
Thank you for listening. This podcast is brought to you by DealHQ Partners. To find out more about our services, visit www.dealhqpartners.com. See you on the next episode.